We can regard the range or flat as a basic element of price charts. Now, double, triple, in fact any multiple top pattern only occurs when price has met a good resistance level, formed a range and could not break through the resistance but broke out on the support instead. This breakout completes the pattern. Whether it's double, triple or four tops merely depends on how many times price bangs its head on the ceiling. Price target is H. In a second scenario, price hits a strong support level at the bottom of the market and we get similar patterns, double bottom, triple bottom and so on. Target is the same as the tops. Double tops and bottoms are the most widespread of the reversal patterns. If you can tell me why, drop me a line. If I agree with you, I'll send you a prize. Next in the chart room is the failure swing, another reversal pattern. It's another head and shoulders mutant, only the left shoulder is missing. You could also see it as a variety of double top with a lowered second top. There you go. The reversal usually happens after a breakout on the trend line or the support, often with some retesting after. So you need to keep an eye on both lines. At the bottom of the market you need to monitor the trend line and the resistance line. A good tip here is to monitor a potential failure swing using the indicator RSI. We discussed this indicator in our film The Essential Indicators. That's the fourth film in our series. What you should look out for is a divergence between the indicator and the price. Here, divergence is noted as price eventually forms a double top with RSI charting a failure swing. Basically, a breakout of RSI is very often a strong signal for a breakout of the trigger line by price. Strong movements often begin with a failure swing, so in spite of the name, if you get in the swing, it could well turn out to be a very successful move. All you've got to do is get with the swing. The next chart from our chart room is the broadening formation. You can picture it as a head and shoulders with a raised right shoulder. There you go. So what you've got is three rising peaks along an either horizontal or nearly horizontal but slanting up support line. Volume decreases with each peak. The pattern is completed by a breakout on the support. With these head and shoulders variations, you can see that the names and the shapes of the patterns vary, but the principles, such as price target after breakout, remain stable. At the bottom of the market, the situation, as usual, would be reversed, with the trigger line being a resistance and the breakout of which leading to a reversal upwards. All you have to do is anticipate the completion of the pattern, plot your support or resistance lines, and, very important this, don't forget to place your orders. Everyone here at Forex Club would encourage you to read up on trading as much as you possibly can. But I'd like to warn you at this point that the majority of books on technical analysis use the terms broadening formation and expanding triangle as interchangeable. This can be confusing because there is a pattern known as the expanding diagonal triangle in wave analysis, and although the patterns look the same with two diverging trend lines, the dynamics behind the patterns are really quite different. We'll be taking a closer look at Elliott's expanding diagonal triangle in our film on wave analysis. You'll often find broadening formations on intraday charts, but take care when you're identifying it. It's difficult to spot and difficult to work with. Many traders have slipped up with it. Let's move on from the reversal patterns. The next item from the chart room is the wedge. Wedges are very interesting and can be both reversal and continuation patterns depending on what type of wedge they are and whether they appear on an uptrend or a downtrend. Wedges are formed by two converging trend lines. The distinguishing feature of the wedge is a definite slant. There are two types of wedges, rising wedges and falling wedges. If the slant of the wedge is in the same direction as that of the trend, it's a reversal signal. So a falling wedge on a downtrend is a reversal signal, and breakout will most likely take place upside. A falling wedge on an uptrend is a continuation signal, so once again, prepare for a probable upside breakout. The price target after breakout is at least the height of the wedge. However, as a rule, price reaches the first correction level, especially if it comes at the end of a long-lasting trend. The wedge should be classified as an intermediate trend pattern. As you'll recall, Dow defined an intermediate trend as lasting from 3 weeks to 3 months. If your main trend is no bigger than 1 to 3 months, the wedges that are formed over 120 to 360 hours, that is 3 to 5 days, are of great interest to you. Once they've learnt about the profit potential of the wedge, many novice traders start looking for it. And they find wedges all over the place. The thing is though, that they're often disappointed by what they've found. We could call this the result of wishful thinking. We need to understand wave theory in some depth before we can identify wedges with certainty. Wedges are explored as a type of diagonal triangle in wave analysis, and in our film on waves I'll do my best to clear things up once and for all. One of the most significant groups of continuation patterns are the triangles. There are 3 main types of continuation triangle: symmetrical, ascending and descending. Triangles are usually described as continuation patterns because they signal that the previous trend will continue. However, if we examine what forces form them, we might choose to be less dogmatic. Triangles map out a period of uncertainty on the market. This uncertainty encourages investment companies and fund managers to take money out of the said market, in our case Forex. Here we are considering time periods of a day at the very least, as these longer periods are of importance to the bigger players. If the longer term developments on a given market are not clear, bigger speculators leave that market by squaring their positions. This happens over a period of time and results in a triangle pattern on the chart. Of course, there are some participants who simply can't get out because of their business. On Forex, these are the banks. They're not here to play. They're simply doing their job, oiling the wheels of commerce. Those who have left the market are sitting on the fence, waiting for some clear signals to act on. The gradual reduction in volume leads to a diminishing fluctuation in price. The banks, who are the majority now on the market, are not actively speculating. They're just maintaining a steady rate. All this leads to a rougher quality in the speed of our two converging trend lines, our support and resistance. Now I've mentioned lines. Remember, we need at least 2 points to draw a trend line. So, as a triangle is two converging trend lines, we need 4 points. 2 points for the lower line, 1 and 3, and 2 for the upper, 2 and 4. So the minimum number of movements inside the triangle is equal to 3. This holds for any triangle you chart, of whichever type. Let's take a closer look at the symmetrical triangle. The two trend lines cross in the future, and the point where they cross is called the apex. If we say that the distance from point 1 to the apex is equal to t, then breakout should occur between a half a t and 3/4 of a t. The zone located beyond 3/4 t is an area I call the no zone, because here the trend lines lose their force. They peter out, and any breakout is likely to be insignificant. Why should our trend lines lose their potency? As we said before, some participants are compelled to stay on the market. These participants endeavour to maintain as steady a rate as possible, and if this situation lasts for a reasonably long time, other patterns such as a trading range may well develop. Mind you, nothing lasts forever, and the clouds of uncertainty will clear in time, revealing a definite direction in price. The direction of the breakout depends on the current state of economic conditions and expectations on the market. Research suggests that 75% of symmetrical triangles are continuation patterns, leaving the other 25% to prove themselves as reversals. What should the trader be doing while a triangle is forming? Well, you can monitor for a new trend using an indicator like stochastic, as covered in our film The Essential Indicators. Or you can check the validity of the breakout using support and resistance trend or speed lines. I'd advise against second-guessing the breakout. Wait for the breakout to occur and then check its validity before opening. Take price target after breakout as the height of the triangle, which is the highest high and the lowest low of the triangle. But remember, once you've passed into the no zone, the power of the triangle is spent. Set the nearest levels of support and resistance and monitor the range. The triangles we've been looking at were formed on daily charts or longer intervals. However, you'll find triangles on hourly and shorter charts. The rules and guidelines hold true for these charts too. Triangles for shorter time intervals take less time to form, and of course, price fluctuation is proportionally less. The bigger fish on the market have already opened their positions, or maybe they've moved on to pastures new. These minor ripples are of no interest to them. But there are smaller fish in the sea. Everything is relative. If you're working with a deposit of $1,000, then a trader who's managing 100,000 will seem like a giant. And from his point of view, someone with a fund of $10 million will seem like a colossus. In short-term periods of uncertainty, even the banks, the market makers, can significantly reduce their trading volume. You'll find both giants and dwarfs working on different time periods. But a symmetrical triangle is a symmetrical triangle, and it obeys the rules that I've outlined regardless of the time period you find it on, and furthermore, regardless of what market you find it on.
Your task is to spot your patterns, plot the lines and place your orders. Pure and simple. The other two triangles in the chart room are both right-angled triangles, ascending and descending.
Let's start with the ascending triangle. It's a close relative of the symmetrical triangle. The essential difference here is that instead of a resistance line, we have a resistance level. This gives us a horizontal upper line. This pattern shows us that the bulls are gaining dominance and are confident that prices will rise further. They are usually right, as an upside breakout is favoured, and the ascending triangle is known as a bullish pattern because of this. But be warned, however, it's not a sure thing.
Only time will tell. Whatever will be, will be. Please remember that the no zone remains in force.
A descending triangle is a symmetrical triangle with a support level instead of a support line. A downside breakout is likely, so a descending triangle is seen as a bearish pattern.
In fact, our exploration of triangles brings us back to the chartist central themes of support, resistance and trend lines. The only extra consideration is the no zone. Let's look at some brief consolidation patterns which are amongst the most reliable of the continuation signals.
First off, we have the flag. What you get here is a sharp increase in price. This forms the flagpole. Then, as often after a sharp rise, there's a pause in the market, a short, choppy consolidation which takes the form of a slightly dipping channel. That's it. You can see why it's called the flag. After the pause, price continues its rise. People say that the flag flies at half-mast, so the price target on breakout is equal to the rise from the bottom of the flag post. The channel forming the flag is a precise resistance line, therefore place your stop loss just below it. Let's fly the flag. The correction can also take the form of a small symmetrical triangle. When this happens, we call it a pennant.
Opening positions and setting price targets remain the same.
Flags obey the wedge rule, that when the flag slants in the direction of the prior trend, then it's a reversal signal. Although these patterns were first identified when traders could only make money on price rises, flags and pennants work just as well on a downtrend, their reversal reflecting the symmetry of the market.
The next chart room favourite is usually referred to as a rectangle, for obvious reasons.
Cast your mind back to multiple tops and bottoms. Picture a double top being formed. You're waiting for price to reverse through the support level, but to your surprise, price breaks out through the resistance level on the third attempt and then continues its rise. This is the rectangle. You could call it a failed double top. All multiples of bottoms and tops can fail. My tip is to keep an eye on volume as the pattern is being formed. Price will most likely break out in the direction of the heavier volume.
This pattern is also known as a trading range. congestion area, and of course Charles Dow would simply call it a line. I'd like to apologise if I'm doing your head in by exploding the myth of cut and dried black and white continuation and reversal patterns, but take a look at this.
What we have before us is an inverse head and shoulders. We described this very recently as an unequivocal reversal pattern found at the bottom of the market. But take a look to the left of the pattern, that's the recent past. What's going on here? The price is on an uptrend, and then head and shoulders kicked in as a correction, and then there's no reversal. What should a poor trader do?
Breathe easy, we're on familiar ground.
You know this pattern and its properties. There's the neckline. Price target will be head height at the minimum on breakout.
Sweet, what else could you wish for from life? As a trader, maybe a surefire thing, clairvoyance, but perhaps life would be too boring with such gifts.
Summing up, I reckon I can say with confidence that we've covered a lot of ground today. We've got to grips with reversal patterns, namely head and shoulders and its variations. We've introduced the fan principle, speed lines, and the wedge amongst others.
Whenever you meet these patterns, remember that they keep their promises, but don't expect more than they promise and don't see them when they're not there.
We've discussed how to identify and chart triangles, the pennant, the flag, and rectangles. These are powerful trading skills. Also, don't forget volume. It's a vital consideration whenever you're working on the market. Throughout this film, I've tried to underline that there's no such thing as a sure thing. Remember, these patterns are only confirmed after breakout of the trigger line. Once again, never underestimate the market.
What we've covered today is not the be-all and end-all of charting by any means. Traders and analysts have been studying the markets for decades and they've unearthed many patterns. As a parting gift, let me leave you with what we in the chart room consider to be one of the sweetest.
Remember our work with channel lines in Chart Analysis 1, okay? Check this out. When price breaks out on a trend line, the correction will come to a halt either at Fibonacci level 0.382 or 0.5. We've got a little piece of the future in our hands right now. When the correction ends either here or here, the trend will continue anew for the length of the prior movement. Let me introduce the measured move, also known as the zigzag.
There you go, a thing of beauty is a joy forever. As I said before, we've covered a lot of ground in these last two films. These two DVDs will help you to go over the examples as many times as you would like, and you can use them alongside your exploration of Rumus's vast data banks. If you have any questions, please contact me on fxc@fxclub.com. I'll be glad to help you in any way I can. In our future films, we'll be taking a good look at Elliott's wave theory, uncovering the mysteries of Japanese candlesticks, and studying the history of some of the world's major currencies. See you again soon!